Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers, and today I'm your host for the podcast. Our guest is Harry Figgie, Partner and Wealth Advisor at Greenwich Wealth Management. Tax loss harvesting is a common topic in investor conversations when looking for tax reductions. But who can utilize the strategy? How does it work? We're going to cover all of that and more. Welcome to the program, Harry.
Thank you, Cassidy. Nice to be a part of the program.
Yeah, of course. Since this is your first episode with us, why don't you explain to the listeners a little bit about how you got started in the industry and a little bit about your background?
Sure. I'm going on my 16th year here at Greenwich Wealth Management as an advisor and more recently partner of the firm. I had the unfortunate timing of graduating just shortly before a great financial crisis. I got my start on an MBS desk, mortgage-backed securities, bond trading, the investments that were credited with ruining the world at the time. So that was pretty short-lived, and did a small non-investment related stint at Bridgewater Associates until I found my way to Greenwich Wealth Management, where I've been ever since, and hope that it's my last stop.
Yes, mortgage-backed securities. One of the vocab words of the late 2000s there. Today, we're going to talk about tax loss harvesting. The market's been relatively volatile, and I think many people are looking at the tax refunds, hopefully, they have recently gotten and then gone, oh my goodness, wait a second, the next year doesn't look as advantageous. So when we're talking about this, what exactly is tax loss harvesting? And is it really something that's more for day-to-day traders, or is it for long-term investors?
Yep. So let me answer the first part of your question, and then I'm going to give you a little bit of background on my firm, how and why we utilize it. Tax loss harvesting definitionally is pretty straightforward, right? You make an investment, you buy it at a price, it's trading below that purchase price, and you sell it at a loss. Then that generates what's called a tax loss. That tax loss can be used to offset other tax gains, potentially some taxable income, or be used as a loss carry forward. The act of selling the security at a loss locks in that loss. Now, tax loss harvesting as an investment strategy, there's a second component, and that's the critical component, and that is reinvesting in a security with a similar return profile. If you don't do the second part and you just sell at a loss, yes, you've generated a taxable loss and that will help you, but that's not an investment strategy. That's managing a position. If you sell it at a loss, wait, or do something like that, that becomes market timing. And both market timing and taking a position are strategies in and of themselves, but it's not tax loss harvesting per se. Does that make sense?
That definition works in the sense of what we're talking about today. But when it comes down to the actual strategies that it's integrated into, or maybe the type of investor, is it for anyone to utilize, or is it more so for a longer term strategy? And some people look at it as, sometimes it's labeled even as like the consolation prize for bad picks.
I can see the consolation prize for bad picks, but no, tax loss harvesting is a defined strategy. Theoretically, anybody could do it. It is challenging if you're a more novice investor, and candidly, it can be challenging for professionals. It's that second component that defines tax loss harvesting, the reinvestment component, where the challenges for more retail or more novice investors, the sort of the pitfalls that they run into. And let me explain why. If you buy a position and you sell it at a loss, you have to then reinvest those proceeds simultaneously, or effectively simultaneously, in an investment that has the same or very similar return characteristics. Ideally, it would be something in the same sector, something that has similar market reactions, things like that. And doing that level of analysis is really technical and challenging. It's not as easy as sell Apple and buy Amazon, or sell Verizon and buy AT&T, something like that. There's also a lot of tax rules, compliance, wash sale compliance, things like that. They can be very difficult if you're not familiar with them. So I would say, yes, anybody can theoretically do it if you can trade, but it's usually best left to a professional and somebody that specializes in tax loss harvesting.
Yeah, and I mean, there's so many layers of rules, of course, when it comes to taxation, but there's also the layer of complexity, which is how are you going to pivot after you make a decision to sell? So that kind of leads me into my next question, which is the pros and cons of it. Initially, you may think, I had a loss. I'm going to try to make the most of that, and we're going to see how that goes. But there's a lot more to it. Are there certain pros and cons that people may not think about or things that are surface level that don't always get discussed?
Yes. On Greenwich Wealth Management, my firm, how we operate and how we use tax loss harvesting, and potentially that'll help frame the answer for the pros and cons and maybe shed a little bit more light on your second question. Greenwich Wealth Management, registered investment advisor, SEC registered investment advisor. We manage about $2.7 billion in regulatory assets under management as of our last filing. We have more or less, call it 500 client accounts spread across 11 investment professionals. So this level of concentration allows us to create really customized and bespoke portfolios for our clients, which range from your everyday sort of clients like my mother-in-law all the way up to ultra high net worth individuals, charities, foundations, things like that. When what we try to do is very firm. So our strategy, generally speaking, is to passively manage or actively manage passive investments. Passive investment be something like an S&P 500 ETF, broadly diversified securities, often index based. And what we try to do is provide incremental improvement over what you would get. And that's how we deliver value to our clients. So things like tax loss harvesting, how we weight different portfolios, security selection. It's one of the reasons we really love IBKR as a custodian: cheaper margin, higher cash interest rates, stock yield enhancement. But one of the core um, strategies that we utilize is this tax loss harvesting, because it can lead to long-term outperformance. So if you put all these things that are a little bit better, a little bit cheaper, a little bit faster, and compound those basis points over a really long period of time, that outperformance becomes really meaningful. And so that was a kind of a sideways way of getting to the pros and the cons. So the pros of tax loss harvesting are tax alpha. It is something that's measurable and definable. At the end of the day, money is fungible, right? So whether you're saving it on your taxes or it's showing up in your account, it doesn't really matter. That's extra dollars in your pocket. And that's the way I look at it. But in order to effectively tax loss harvest and take that away from a consolation prize from a bad pick, you have to systematically do it over a very long period of time to have it be a meaningful strategy. Doing it meaningfully over a long period of time can become challenging. If you think back to the bull market run up until February of this year, as stocks go higher and higher and the markets move higher and higher, y- you the strategy can atrophy, right? You run out of losses to harvest over a certain period of time. So the professionals that engage in tax loss harvesting make a, let's say you want to replicate the performance of the S&P 500. You wouldn't necessarily buy all 500 stocks. You might buy a representative basket of 210, let's say, or 220. And that way, you have enough, you have a deep enough bench to, when you sell a Verizon or you sell an Apple or something, you have a stock that you can put in there, avoid the wash sale rule, rinse and repeat, and keep this strategy going over a long period of time. Tax loss harvesting on a one-off can make sense, but really, if you want it to be a strategy that adds measurable alpha over a long period of time, there are a lot of considerations that I just don't think your average retail investor can do without the assistance of a professional.
Yeah, a lot of people will look towards this as a potential for a portfolio rebalance or outside of recouping losses, some ways to help offset it. I'm just curious, how do you usually answer the question of people saying, okay, I do have the opportunity to do this with someone who's more of an advisor or somebody more professional to help me utilize tax loss investing. But is there a potential for missing on future gains? Like, how do you weigh the opportunity risk? I'm just curious from your perspective as somebody who's been larger funds and more home style funds or personal
Yeah,
funds.
that's a great question because, and that always, that, it's one of the investor psychology aspects that makes tax loss harvesting really tricky. In order to do this effectively, first of all, it has to be systematic. You have to be dispassionate about it. So, if you are a long time holder of, let's say, NVIDIA, maybe you don't have any tax losses that you can harvest. But let's use that as an example. That's a stock that people feel near and dear to. They don't necessarily want to sell it, or if they do decide to sell it, they worry, is Taiwan Semi or whatever the closest analog, is that going to give me the same upside? Mm, Those type of considerations, you have to remove yourself from those and take a very math based approach. So when you do sell a security and harvest that loss, you need to find a security, a placeholder security long enough to avoid the wash sale that will have the return, same or similar return characteristics over that 31 day period. Um, and then you can sell that and then replace that with whatever your desired investment is. That analysis of, when I sell in the video, what do I replace it with for the placeholder period? That is really technical analysis and often beyond the scope what a lot of even investment professionals can provide. That's why there are a lot of tax loss harvesting services, and they'll be happy to walk you through what their process is, how they identify replacement securities, how do they know how long to hold them. Also, too, what is the effective level of loss? That's the other thing. All right, just when it goes negative, it doesn't make sense to harvest $100,000 or $100 tax loss. And if the stock's going to turn around and rally, sure, but maybe that $1,000 or $100 would be 5 or 10, and that might be more effective. So really, there's a lot of consideration within portfolios, within the construction of portfolio, within the methodology that you're using to approach tax loss harvesting. So it's a generally easy concept that becomes very difficult in practice.
Yeah, I mean, there's totally an element of specificity or circumstance that goes into it. Because as you mentioned, depending on what your goal is or what the level of loss you were looking for or turnaround that you're expecting, all of these elements come together where you have to work with a roadmap of what these potential outcomes could be and what's the most advantageous. But with all of these layers of complexity and details, if someone were to do this, whether it's with a professional or consider it on their own, what are some things to keep in mind when they're incorporating this strategy into their financial goals, or maybe if they're just listing it on a wish list of something they want to learn more about. What are some things to keep in mind? Wash rule was mentioned several times in our conversation today. If anybody is curious about that, I would definitely check it out on our glossary on the IBKR campus, but that's a common one.
Yep. And so first is to understand the IRS guidelines on investment losses. So whether that be wash sale, what losses can apply to what type of gains in your taxes, how to utilize wash loss carry forwards. It starts with understanding the tax rules because that will determine how it changes your tax picture and thus your tax alpha. When I say tax alpha, alpha simplistically is the excess returns generated by an investment decision. So if you decide to realize a loss and engage in tax loss harvesting, what is that really going to mean for excess returns, and how do you measure that on a percentage? And if you don't know the tax guidelines for that, you can't calculate that, right? So it all starts with understanding the tax rules. Then the next part is the important part, and that is understanding what you're selling, understand what the replacement is, and try to remove, to the extent possible, investor psychology from the equation, right? If you need a dispassionate, systematic approach to do it effectively over a long period of time. Now, that's not saying take a loss on a stock that you know really well, replace it, sit in cash, and generate the loss. There's a difference between long-term tax loss harvesting as a strategy and harvesting a loss. If I didn't make that nuance clear, let me know and I can try to define that a little better.
Yeah, there's definitely the nuance of what exactly would you like the outcome to be from this loss, and then what's actually applicable to you and your situation and your portfolio. When you're working with people or portfolios, is there any mention of any type of cost basis method? I know this is a little of more of an intermediate topic. We don't have to go too deep into it, but I'm just curious because some people may look at their cost basis and say, okay, this is a whole other rabbit hole. Is that an element that is taken into consideration often when you're looking into tax loss harvesting? Or is that something that is more just the simple, okay, what did you pay? How are we going to incorporate this if there's any sale going on, LIFO, FIFO, etc.?
Yeah, absolutely. Another point for IBKR as a custodian, tax tools, the lot matching tax tools become very important, especially I think a lot of people, even your more novice investors, understand the power of dollar cost averaging, or maybe just doing it accidentally by, all right, I have some extra money in my paycheck. Let me put that into my account. I'll buy whatever I'm buying. And you do that sort of over a long period of time. It's kind of a backdoor into dollar cost averaging. So when you bought the security for what price and at what tax lot becomes very important. And if you have the tools like you do with Interactive Brokers to select a methodology, whether it's last in, first out, highest cost, lowest cost, maximizing long-term gain. There's a number of different strategies, or just identifying and selling a specific lot. It's almost the backbone of a tax loss harvesting strategy.
I'm glad I mentioned it then. And it's great that you mentioned dollar cost averaging because that's actually one of our other recordings coming up in the next few weeks. It seems like it's the season of talking about how to really think about how you're investing. Riding the wave was a big thing for a while. And now we're looking for a more grounded approach of explaining some of these foundational topics. And our tax loss tools at IB, for the most part, from what I know, they're free, like our tax loss harvesting tool. And you can find all of those on our website, but you've got some great anecdotes and some great points brought up today. Thanks for joining us, Harry.
Thank you. And thanks for having me, Cassidy.
Yeah, of course. So as always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Feel free to leave us a rating or review and follow us on your favorite podcast network. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Interactive Brokers does not provide tax advice, does not make representations regarding the particular tax consequences of any investments, and cannot assist clients with tax filings. Investors should consult with their tax professional about the tax implications of any investment. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Tax loss harvesting involves selling investments at a loss to offset capital gains, which carries inherent risks, including potential loss of principal and market volatility. There is no guarantee that tax loss harvesting will achieve desired tax benefits or investment outcomes. The projections or other information generated by tax loss harvesting or tax optimizer regarding the likelihood of various investment outcomes are hypothetical in nature, do not reflect actual investment results, and are not guarantees of future results. Please note the results may vary with use of the tool over time.